Next, let's do a little quick review about accrued revenues. So what are accrued revenues? Well, these are revenues that we've provided the product or services, and remember, provides means we've recognized, right? We're going to recognize revenue, which means we're going to increase revenue. This also is performed the obligation, right? This is an important term for your exam. Know this term for your exam. Perform the obligation. That is going to tell you, if you see that term, that you get to recognize revenue. So, accrued revenues occur when the company provides the products or the services, right? So we're going to recognize revenue, but we haven't received any cash from the customer. They have not paid us yet. So since we've provided goods or services in the current period, we have the right to receive the payment. That's what these accounts are telling us. We have the right to the amount that we feel we deserve, and that's going to be what we told them we provided the service for. So what we're going to do is we're going to record an asset for the amount expected or owed. Expected will become important later on in Chapter 5. But we're going to record an asset, so this is an increase in an asset. Typically, this is going to be accounts receivable, right? And we're going to recognize revenue, whether it's service or sales, okay? And just remember, recognize is an increase to revenue, okay? So let's take a look at an example. So again, this is an example that we used in Chapter 3, but now we've got a little bit of information. On December 31st, services of $7,000 have been provided to customers, but have not yet been billed or collected. Not yet been billed or collected. So this means that we have receivables from customers. So we provided $280,000 already on account by December 17th. Well, in the next 2 weeks, we've provided an additional $7,000. So we're just going to add to our AR here, right? That's what this is doing. We're adding to our accounts receivable. So now we're owed $287,000 from customers, okay? And then on January 10th, right here, it looks like they gave us cash. We received, cash received, we were paid, okay? So what do we need to do? Well, we need to make an adjustment here, okay? Need to make an adjustment for this $7,000 that we provided in addition to the $280,000. So what accounts are affected? Well, they're the same two accounts, accounts receivable and service revenue, right? We just talked about that. Receivable tells us, hey, they owe us some cash. Revenue tells us we got to recognize it because we earned it. We provided a service or a good. So do they increase or decrease? Well, accounts receivable is going to be an increase to assets. And service revenue, obviously, says revenue in the title. We're going to be an increase to revenue, okay? Do our assets still equal liabilities to stockholders' equity? Yeah. Absolutely. We increased assets and we increased stockholders' equity because remember, an increase to revenue will eventually be an increase to stockholders' equity right here, okay? This is what happened numerically speaking from a numbers perspective. We made an adjustment for accrued revenue. We increased our accounts receivable by $7,000, but we also increased our service revenue by $7,000 because why? We earned it. Okay, so what's that journal entry look like? Again, pretty simple, okay? So we've got the adjusting entry. Remember, we're just doing this to correct the balance, okay? Making sure that our balances are correct at the end of the period, okay? We're going to increase accounts receivable. Why? Well, write down your debt acronym. It does not hurt you guys to write this down. I still write it down, okay? So it's not going to hurt you guys to write it down at all. Where are assets? They're right here, okay? How do they increase? Well, if it's in this acronym, it increases on the left as a debit. So that's what we've done here. Service revenue, not included in here, so we're going to increase it with a credit, okay? Pretty simple journal entry. AR entries are typically pretty easy, not super confusing, but we just wanted to review what's an accrued revenue and how can we sometimes have to make an adjustment to that during or at the end of the period, okay? So the next thing we want to talk about is the adjusted trial balance. Remember, we talked about the original trial balance in Chapter 3, and that just told us, hey, our debits and credits are equal, right? The original trial balance just says debits and credits are equal. However, the adjusted trial balance we prepare after we've made all of these adjusting journal entries. Okay, after all of your adjusting entries are posted to your general ledger, we have debit balances on the left, credit balances on the right, and it does tell us two things. It does tell us now that they're correct. Okay, this is the important distinction between an adjusted trial balance and your original trial balance. Your adjusted trial balance tells you that your balances are correct, that there are not any real errors in it right now. And it also continues to tell you that your debits equal your credits. Okay, so it's going to look like this, and this is what we will use to start creating our adjusted financial statements. Okay, so this is just an example of what your adjusted trial balance looks like. You'll notice again, we've got anything with a debit normal balance on the left, anything with a credit normal balance on the right. That makes sense, right? Because if it's a debit normal balance, it simply means at the end of the day, its ending balance should be a debit. If it's a credit normal balance, same thing, except its ending balance should be a credit. Okay, so now we're going to report out to prepare our financial statements. Okay, we're going to create the income statement, the statement of retained earnings, and then your balance sheet. You can look and closely try to determine what goes where based on the position in your trial balance. Okay, so up here you can see all of these accounts from cash all the way down to notes payable. Okay, those are going to be your assets and liabilities. Then you've got common stock, retained earnings, and dividends. Those are all your stockholders' equity accounts. And then down here, you've got your sales revenue all the way down through to your interest expense. And those are going to be your income statement, revenues, expenses, and net income, assets and liabilities plus stockholders' equity. You can see we've got our income statement and balance sheets there. Notice here again, though, these are equal, right? There is balance. Okay. So when we get back for the next video, we will start talking about how do we actually prepare these financial statements. If you have any questions about the last of those transactions as well as an adjusted trial balance, feel free to contact me. I'm more than happy to answer your questions.